In credit and debt. What is credit? Credit is the ability to borrow money or receive goods and services with the promise to pay later. When you use credit, you're essentially borrowing money from a bank, a store, or a lender. You are expected to pay it back, usually with a little extra called interest. Example of using credit: imagine you want to buy a new video game, but you don't have enough money right now. If the store accepts credit, you can use a credit card or a loan to buy the game. Later, you'll have to pay the store or the bank back the amount you borrowed, plus any extra charges, interest. Credit comes in various forms, including credit cards. These let you borrow money from a bank to make purchases. You pay the money back later, either all at once or over time. Loans. A loan is a sum of money that you borrow and pay back in installments, usually with interest. Common examples are student loans, car loans, or home loans. Store credit. Some stores offer credit to buy items, and you pay it back over time. What is debt? Debt is simply the amount of money you owe to someone because you borrowed from them. If you take out a loan or use a credit card, you're in debt until you pay it back. Example: if you borrow $50 from a friend, you are in debt to them for $50. If you don't pay it back on time, the amount you owe may grow due to interest, and your friend may charge you more to cover the cost of borrowing. Good debt versus bad debt. Not all debt is the same. Some types of debt are good, can help you build your future, while others are bad, can lead to financial problems. Here's the difference. Good debt, student loans. Borrowing money to pay for education can be a good investment in your future, as it might lead to better job opportunities. Mortgage, home loan. Buying a house is often considered good debt because property can increase in value over time. Bad debt, credit card debt. If you only make the minimum payment and carry a balance, the interest charges on credit cards can pile up fast, making it harder to pay off. Payday loans. These loans are high-interest, short-term loans that often lead people into deeper financial trouble. Interest. What is it? When you borrow money, the lender usually charges you a fee for using their money. This fee is called interest. Interest is added on top of the amount you borrowed, making you owe more than what you initially borrowed. Example: let's say you borrow $100 using a credit card. The bank charges you 10% interest. So, you will owe $110 after a month, the $100 you borrowed plus $10 interest. The more you borrow and the longer you take to pay it back, the more interest you will pay. Summary: credit is borrowing money to pay later, and debt is the money you owe to others because you borrowed it. Good debt helps you achieve important goals, like education or homeownership, while bad debt, like credit card debt, can trap you in financial trouble. Interest is the extra cost you pay for borrowing money, and it can make debt more expensive if not managed well. Using credit responsibly can help you build a good credit history and score, but not paying back what you owe can hurt your financial future.